How do below-the-line tax deductions reduce my taxable income? Imagine you're filling out your tax forms and wondering how to lower the amount of income the government taxes you on. Well, below-the-line tax deductions are a big part of that puzzle. They are specific expenses you can subtract from your adjusted gross income to find out how much of your income is actually taxable. First, let's clarify what tax deductions are. They are amounts you subtract from your total income to lower your tax bill. There are two types, above the line and below the line. Above the line deductions are subtracted first from your gross income to get your adjusted gross income. These include things like student loan interest payments or contributions to health savings accounts. Below-the-line deductions come after that. They are subtracted from your adjusted gross income to determine your taxable income. Think of it as the final step before calculating how much tax you owe. These deductions include things like mortgage interest, property taxes, medical expenses, and charitable donations. The standard deduction is also a below-the-line deduction, which means you can choose to take a fixed amount instead of itemizing your expenses. Here's how it works in practice. First, you add up all your income from jobs, investments, and other sources. Then, you subtract above-the-line deductions to find your adjusted gross income. Next, you look at your itemized expenses like mortgage interest or medical bills. If these add up to more than the standard deduction, it makes sense to itemize. If not, taking the standard deduction simplifies your process. Once you decide, you subtract your chosen below-the-line deductions from your adjusted gross income. The remaining amount is your taxable income. This is the number used to determine your tax liability based on the current tax brackets. For example, if your adjusted gross income is $50,000 and your itemized deductions total $10,000, your taxable income drops to $40,000. For Asian American taxpayers, understanding these deductions can make a real difference. If you own a home, mortgage interest can be a significant deduction. Medical expenses that exceed a certain percentage of your income or charitable donations can also lower your taxable income. Remember, the key is to keep good records of these expenses. Receipts, bank statements, and property tax bills are all helpful when it's time to file. It's always wise to consult a tax professional if you're unsure about what qualifies. They can help you maximize your deductions and ensure you're following the rules. By using below-the-line deductions wisely, you can reduce your taxable income and pay less in taxes. That means more money in your pocket and less stress during tax season.